Here I intend to go through my eBay analysis. So if you like this style of content and you get something out of it, then please drop me a like. If you'd like to see more of this style of content, more stock analysis, then please subscribe. I try and do at least 2 or 3 of these a week. eBay, I wanted to do a very quick analysis of, because they recently dropped around 9 to 10% in share price value. So let's see if it's created a buying opportunity or if it was rightly to drop that in the first place. So what is eBay? So eBay is a multinational e-commerce corporation based in California that facilitates customer-to-customer, business-to-customer sales through its website. eBay was founded in 1995 and became a notable success story of the dot-com bubble, one of the only companies to survive the dot-com bubble. So headquartered in Santa Clara, California, it has approximately 13,300 employees and an annual revenue of just under 11 billion. And its current CEO since April 2020 is Jamie Anioni, I believe it was how you pronounce it. Competition. So eBay doesn't really have any direct competition in regards to an auction online website, not at the size eBay is. But I believe it will be losing market share to companies like Etsy, Amazon, Alibaba, companies like that. But also more recently, I believe, Facebook Marketplace. So I sell a lot of my second-hand computer hardware. And over the years, I have used eBay in order to do that. But more recently, everything that I've sold, I've done it on Facebook Marketplace because they don't take a cut. And I've generally got what I wanted for it. And it's only taken 1 or 2 days in order to sell it. So why wouldn't I? So that would be, I'd see that as a threat building to eBay's business model. So let's get into the analysis. So both Moody and S&P both grade eBay as lower medium grade, which is just above speculative grade really. Vulnerable to changes in economic conditions, but nevertheless, these companies largely demonstrate the ability to meet their debt and payment obligations. So, okay, not great. Common size analysis. So I struggled with the common size analysis of eBay because their financials are actually all over the place. I believe this is because they do a lot of mergers and acquisitions and spin-offs. So to try and make sense of their figures is difficult. One notable thing is revenue. So from 2017 to 2018, they did really well. They increased their revenue by just over $1 billion. But since 2018 onwards, it's been pretty much flat, trending flat, if not slightly down. Cost and goods and services, also not great. So it is fairly low, a percentage of revenue to begin with, but it is trending up. So they're not being more efficient with how they deliver their goods and services. Gross profit is pretty much trended flat. Operational expenses is trending down, as well as sales, general and admin. So operational wise, hopefully they're getting slightly more efficient. Another thing to point out here is over the past 4 years, they've spent just under, or just around 5 billion in R&D, which has not translated into any notable change in revenue, which would be worrying. You would expect that to have some kind of impact on revenue. And also, 2 more things to point out. In 2017, highlighted in red, they had a loss of just over 1 billion, and in 2020 they had a profit of 5.6 billion. So again, I think this is probably down to mergers and acquisitions, but again, something to deep dive into. And also free cash flow has also trended down on average, which is not really a good indicator, which won't give a good free cash flow to price indicator either. But they have come back up since, which their free cash flow as of 2021 sits at around $2.5 billion, I believe. Earnings consensus. So they missed the Q2 2020 analysis consensus, but they managed to beat the rest of 2020. And recently they just slightly beat the Q1 2021 analysis consensus of EPS target, which the market didn't react well to. I think they were hoping it would beat it a lot more than it did, and henceforth the share price shed about 10% of its value. And also, as you can see from the trend over on the financials, the revenue is pretty much trending flat and earnings is trending up on average, but again that's probably down to spin-offs, M&As. Moat Analysis also doesn't show that much of a rosy picture, so no problem on EPS. I've had to use the average over 3 years because the fourth year was a negative. They didn't make any money, so you can't really calculate EPS. So they're averaging over the last 3 years 46%. Operating cash flow per share only 8%. Revenue on average down -2%. And book value per share down -8% on average. Not great. So let's see how the directors are managing this business. So return on equity 71%, which is far higher than that 10% that we're looking for, and I believe this is down to the eBay very aggressively buys its shares back. And return on invested capital at 22%. No issues there. The debt to earnings ratio currently stands at just very marginally over those 3 years. So again, not really anything to worry about there. Margin of safety. So using the earnings per share trailing 12 months at $4.12, earnings growth rate at 15%, which is probably quite optimistic, but using the analysis consensus, they must be looking through rose tinted glasses on that one. Future PE multiplier, again probably higher than it should be at 12.32, and minimal acceptable return to us at 15% would produce a valuation of this company currently at $50.76, which feels about right in my opinion. So a margin of safety off that valuation would be $38.07. And again, if 50%, if you wanted to play super safe, would be waiting for the share price to be around $25.38, which may not happen, but you never know. So where are we at the moment? So we're currently trading at $55.79. So that's above my model's valuation of this company by around 10%, because this model's valuing it at approximately $50.76, and it's still way above that 25% margin. So again, this stock is probably a wait and see, because personally I just don't see, granted I haven't deep dived into this company yet, but I don't see where that extra growth is going to come from. It may come from one of its mergers and acquisitions, but who knows. So let's check out the foundations. So 8-pillar analysis, I have it passing 6 of its 8 pillars based on a share price of $55.79, market cap of 38 billion. So PE ratio sits at 13.53, well below that 20. Profit margin, they're achieving 25.94%. The revenue is not growing, their profit is not growing. They are massively decreasing their outstanding shares, and their liabilities currently sit at 81% of their assets. And free cash flow growth, it is growing slightly on average, but not last year to this year. Price of free cash flow currently sits at 15.91, so it's definitely between that 15 and 20 that we're looking for. So if we run this back through again at a 25% margin of safety, so a share price of $38.07, So outstanding shares 710 million, which would give a market cap of 27 billion, and a free cash flow that currently sits at 2.3 billion would give a PE ratio of 9.3 and a price to free cash flow of 11.3, sorry. So I mean, if you look at the 8-pillar analysis, if you look at the PE ratio, it does look like a cheap stock, but the market doesn't seem to like it. And so and again, I think this is because, you know, what's the catalyst in growth here? Where is eBay? With what eBay does, where is its next jump? It's hard to see. So pros regarding continued growth: pretty much still the only online auction, no real competition at the moment. If you look at a couple of their mergers and acquisitions, I think they buy their competition out before they even get established. It makes good acquisitions, which I'll briefly show in a minute. And it also has a massive user base and has a massive reach. So if you sell something on eBay, you're selling to hundreds of millions of people potentially. So this isn't the whole list of mergers and acquisitions, but I just thought I'd take a cut of it and sort it by value. And so at the top you've got Skype, PayPal, Craigslist. Some of the things that I know, some of these things I've never heard of at all, but they do a lot of mergers and acquisitions, and they also spin them off as well to make a profit, such as PayPal. Limiting factors, I think Facebook Marketplace is going to really start to pinch eBay's market share pretty much soon enough. Because if eBay is charging a fee of 10% to sell whatever you're selling on eBay, and you can sell it for free on Facebook Marketplace, so maybe if it's just customer to customer, you're probably going to use Facebook Marketplace. But if you're a business to customer, then you may want to use the reach of eBay. They've also got currently quite a lot of bad publicity around counterfeit products and fake ads. Now, I've personally been impacted by this. So someone kindly was trying to sell my Porsche on eBay for me. Very kind of them, but it wasn't for sale. So again, revenue has not grown over the 3 years, and for an analysis for a stock analysis, it's pretty difficult because the figures are all over the place. So you'd have to spend some time trying to pick through it to find out what has eBay actually generated and what has been through buying and selling companies. So my conclusion. So credit rating, no real issue. Common size analysis, there are issues, but you could probably get around them. Moat analysis, there are some worrying things there. Return on equity, return on capital invested, nothing to worry about. Long-term debt, nothing to worry about. It'll be able to facilitate its debt. 8-pillar analysis, only passed 6 of its 8 pillars. So my concerns with eBay, again, I know I've said it a couple of times, it's stagnated over the last 3 years. You'd need to do further investigation in regards to what is its plan going forward. How is it going to make that next jump to warrant its 13 PE ratio? And also competitors are starting to eat away at the market share, and that's probably due to eBay's high fees. I believe it's currently overvalued at $55.79, and I'd wait for a good price using a 25 to 30% margin of safety and go in at around $35 to $40. So what do you think of this valuation? Would you agree? Also, I haven't done a huge amount of research on this yet, so am I missing something? Because I possibly could be. So please drop me a like if you've enjoyed this content. And also, if you believe I've missed something, please drop a comment, and I'd like to include it in the analysis. Thank you for dropping by, and goodbye.